right, guys. Welcome to this episode. Now, so in this episode, I'm going to walk you through some of the avenues or some of the strategies that you can use to free cash. And these avenues that I'm going to talk about are particularly going to help the individuals that are under formal employment. If you are under formal employment, please, I want you to listen keenly or follow keenly so that you'll be able to take this advantage, because the majority have been saying, or it is evident that actually that if we compare maybe the previous administration and to this administration, and generally we can say that the cost of living cost of living is going high, and at the same time we can say that also due to the cost of living and also all the balance, government is also trying to mobilize more funds through public debt, and at the same time through what through the taxes or the internal means. Now, in this context, you know very well that income tax is one of the major contributor to what we call revenue collection. Okay, so yes, being that you understand about the public finance, whereby we say that the government on the behalf of citizen generate or collect or mobilize revenue, then they use revenue to pay for the public utilities or to offer public utilities and all that, all to run the country as all. So having understand this, there are other avenues that maybe somebody who is not well informed cannot know. Maybe you are employed somewhere and you don't know about whatever I'm going to talk about here. So whatever I'm going to give you today is just a strategy which is not illegal. It is legal strategy which is actually provided by the government. When you go through the income tax cap 470 section 30 and 31, there you will find actually whatever I'm talking about. So the thing is, for those people who have for those people who usually do file returns, I'm talking in the context of Kenya. So for those guys who do file returns on your own, there is usually some questionnaire, or there is usually a questionnaire that you fill in. You're being asked, do you have a home? Not do you have a home really, but do you have a mortgage? Okay. Do you have a home saving ownership plan, or do you have life insurance, something like that? Okay, so those questions you are not usually being asked for no reason. There is a reason why you're being asked those questions. So we normally just take no as we populate the page. So there is a something very important that I want to let you know, so that you see on how best you can make good use of that. So when you use all these strategies, you will end up freeing some cash, because you are going to use what we call tax planning or tax management, or what we call tax avoidance, and tax avoidance in the context of Kenya is legal, and it is different from tax evasion. So tax evasion is illegal, but tax avoidance is legal. So then it takes your knowledge to know what you should do at what particular time. But for those people who are not well informed in this tax management, cannot understand, and I want to take this opportunity to maybe shed some light to you so that you can know some of the areas that you can use to actually alleviate some burdens that you have as an employee or as somebody who is in the formal employment. Now there is a provision that there's a provision under the Income Tax Act that states that there is what we call insurance relief, which is usually 15% of the premium paid. So for 15% of the premium paid, but again it is capped at 5,000 per month or 60,000 per annum. Now we find that majority we do cry that, you see, tax is high and all this and all that, but even the avenues that are available for you to reduce or to claim tax relief you've not used, and I can't blame you because maybe you don't know, but now you will know once we've discussed this. So I'm saying that there is a provision for tax relief, which is usually 15% of premium paid towards insurance. Now it is usually 15%. So I want to explain, or I want to give more insight on this. So I want to start with the NHIF, which now we call it SHIF, that is or SHA. So there is a provision. So for SHA, let's assume that one is automatic, or of course your employer knows about that. So with that, they will just populate automatically. So I want to calculate, once we have worked with the premiums that, or the tax relief that shall have claim on the insurance, because that one is always automatic. So even when you are finding your returns, already you'll find it captured there. But I want us we are not usually using this what we call incentives to the maximum. So I want to show you on how you can utilize this to the maximum, so that you ensure that you are within the rules, or you are within the law, and you are alleviating some of the burdens that you have, considering the current economic condition, and also as we claim that there is a tax burden and all that. Yes, so I want to assume, for example, somebody who is earning a gross income of 150,000. A gross income of 150,000, and so we know very well that the contribution to SHIF, when you're contributing to SHIF, the rate is supposed to be SHIF 2 point is it 2.75? Let me just confirm so that I be sure. So contribution to, I want us to calculate this thing so that you know what you should do. Yes. Yes. So SHIF is 2.75 of your gross income. So I want to calculate this so that you be able to know what you should do, or how you can reduce your tax burden, or how you can free some cash. Because when you reduce tax payable, it means that you freed some cash, because without that you would have paid the full amount. So I want to, or if not, also if maybe if you don't present this policy to your employer, you can use this policy on your own when you're filing your annual return. Then do what? Then you can you get what we call a tax credit. So please, this is money I'm talking about here, so be careful enough and ensure that you don't, like you see here, I do say that you learn, you implement, and you grow. So you must use all of them. So if you just learn and you don't implement, no growth. Yeah, so just a reminder. So I'm taking in this scenario this someone who is earning 150,000 per month as gross, and shift will take 2.7% of this of this gross income. So let's calculate how much would this person pay to shift. Okay, then from there we'll calculate what's the amount of insurance relief that this person shall have claim from this shift or premium paid to shift. Then from there we'll know within the limits or within the cap that we are having, how much is it still remaining under insurance, so that we can look for other insurance that we can pay which is strategic enough then to reduce this burden. So let's go together. So I'll take I'll calculate what 2.75% of the of the 150,000, and that gives me, so this person will pay 4,125 as premium per month to shift. Okay, now then we are saying that 15% of this one is tax relief, or is allowable tax relief. So let's calculate 15% of this. So that is 0.15. So 15% of 4,125 is 618.75. Now I'm saying this, I've calculated what is 2.75% of 150,000. What is 2.75% of 150,000? So I'm assuming this person is earning a gross income of 150,000. Okay, and after calculating that, I found that that one is giving me 4,125. So I've said that it is provided under the income tax cap 470 section 30 and 31, that insurance premium, somebody who has paid insurance premium, you are entitled to insurance relief of 15%, but subject to a cap of 5,000 per month or 60,000 per year or per annum. So I've went ahead and calculated. Now I've calculated 15% of 4,125, which is premium that is paid to shift to shift social health insurance fund. If for example you are earning 150,000 and I've found that it is 4,125, then I've went ahead and calculated. Now this one would grant you what relief in a in a month, and I found that it is 618 shillings 618 shillings and 75 cents. Now, and I've said that a cap per month, okay, a cap per month, the relief that you are granted per month on insurance only is 5,000. So it means you still have a loophole. You still have a loophole of what? That is 5,000 less 618 that you can use to reduce the tax burden. I hope you are getting me clearly. So 5,000 less 618 and 75 cents. So you are still remaining with a relief of 4,381 and 25 cents that is not tapped on. That is just free. It is there. So it's only those people who know that will make good use of this free cash of 4,381 per month, and per year this one would translate to, you multiply by 12, that one would translate to 52,575. 52,575. 52,575. 52,575. Now, this is not theory. This is practical thing, and you can go to you can refer this in income tax cap 470 section 30 and 31, and you'll know this. Now, this is implement this as fast as you get this information, or as early as you get this information, or with immediate effect. Now, this what will now let's see how can you now ensure that you tap on this 4,381 and 25 cents per month. What can you do? Okay, so what my advice to you is this, and this is what I want you to do. I want you to have a insurance, take a life insurance or life assurance which is lasting for not less than 10 years. Which is lasting for not less than 10 years. So under life assurance, we usually they are usually categorized into two. We have endowment and we have whole life. So for whole life, if you take whole life, it means that you cannot, this insurance cannot mature until you die. So technically it means that it's only the beneficiaries that can get the sum assured. Okay, and the sum assured is just the amount that you will get compensated once the maturity of this policy is attained. So I want to focus on endowment policy. And on endowment policy, it also means term policy. It means you are taking a life insurance, but it's having a term, it's having a maturity. So it can have a maturity of 20 years, 30 years, or even 15 years. So it depends with the policy that you've taken. Okay, so I want to say, for example, you've taken this endowment policy or life policy which is going for 20 years. So from the time you take this policy to 20 years, if you don't die, if you don't die, then you will be compensated the sum assured. Okay, you will be compensated the sum assured. So in this case, that policy you are having, you will use it to claim this relief or to unlock this cash that is here. And when you don't die within the 20 years, the premium that you've been paying, the premiums that you've been paying, or the sum assured you will receive. So you shall have, and you shall have technically you've been saving, you've been saving, and at the same time alleviating tax burden. Are you getting my point? So then what you will need to do is to know that what premium should you pay so that you make good use of this 4,000 and what 4,381 and 2 cents. So what I'll do, maybe somebody might not be able to calculate that. So this is how you can go about it. I'll just form an equation. I'll say that so 15% of X should give me what? Should give me 4,381 and 2 cents. So I want to find the value of X so that we know that what premium should you pay so that you take advantage of the free cash, that free cash. So that one would be that simple. So that is just 4,381 and 2 cents divided by 0.15. Yes. So this is the thing. If you contribute a premium of 29,208 and 33 cents, 29,208 and 33 cents per month, you shall have taken advantage of that insurance relief available after taking into consideration the insurance relief towards shift. So you shall have taken the advantage of the entire insurance relief. And assuming that the life assurance or assuming that the life assurance that you have is giving you an interest of let's say 8%. Let's say 8%. Yes, let's say 8% per month. Let's say 8%. Let's say 8%. And so that, okay, so this one will be we can say you are using determined contribution. So determined contribution, so that I want to calculate sum assured. So at the at the end of the 20 years, how much will you be having in terms of sum assured? So let me I told you that I work with models to understand or to travel, to time travel, or go ahead, or to focus. So just let me just see. Okay, I want to compute that and see. So I'm saying my is 20 years or 20 years. So the 20 years translates to 240 months. Then interest rate, I'll say that I want to use just 8%. Compounded monthly, just 8%. I want to use 8%. Then I've said that you are contributing what? I've said that you are contributing for you to take advantage of the whole free cash of free cash of what? 4,381 and 25 cents. You are supposed to contribute 29,208 and 33 cents. Yeah. So you are going to contribute 29,208 and 33 cents to take advantage of what? Of this 4,381. So this one is just a tax credit that you are going to take, that you are going to have, or that you are going to lock, just because you've understood that these are some of the incentives that have been given to you by the government, so that they encourage the saving culture, or they encourage protecting your future. Okay, protecting your future. So having this one, so if you contribute this, then by the end, okay. And by the way, another thing also, this one is not being taxed. The premiums or the sum assured that you shall have garnered is not being taxed. So you are not going to be taxed on this. So assuming that the interest rate is 8%, so at the end of the 20 years, if you don't die, then you shall have generated a gross interest of 29,000. I mean, not 29,000, but 29,785,179 and 65 cents. Then add to the principal or to the premiums that you've been paid, which is by the end of 20 years shall translate to 7,009,999. So what would be the total sum assured? So let me just add that. So 7 million $7,999 $7,009,999 2 cents. Then gross, all the interest being that is not going to be taxed, is 29 plus 29,785,179 and 65 cents. So sum assured on this is 36,795,178,000. Sorry, 36,795,178 and 85 cents. Let me repeat. Sum assured at the end of the 20 years, if you don't die, the money that you will claim from your insurer is 36,795,178 178 and 85 cents. So that is sum assured. I assuming that interest rate on that is 8%. And somebody would ask me, but you are going with the principles of insurance. One of them is indemnity. A principle of indemnity that ensure that you get compensated or you get reinstated to your previous financial situation before the risk occurred. But I want to say that in this case, yes, you are being indemnified. The interest rate is just being awarded to take care of inflationary risk. To take care of inflationary risk, yes. But this one also you can use this as a strategy, a saving strategy. So with that 29, just with 29, with 36 million 785, with 36 million 795,178 is a good money. So this money at this in the next assume that you are now maybe 35 years, and so that one would 20 years from there, that would be around when you are at your 55 years. So you will be having this one, and at the same time you'll be also having some cash from the pension, and at the same time all this period you've been saving, what you'll be having this tax credit. Okay, so I think this is a good deal. This is a good thing that I wanted to share with you, so that somebody who can take advantage of this, yeah, please take advantage of this. Then I think it's very important. And yes, so that's all I had for you today. So ensure you share this video, and ensure you break this concept down to somebody. You break down this concept to somebody who might not have the equal ability to fathom or to understand this. And at the same time, I want to ask you, if maybe you are meeting these videos or for the first time, please you can follow me when you're meeting this video on Facebook, Instagram, and also you can subscribe when you're meeting this video on YouTube, so that whenever we upload new contents, you be the first person to do what? To be notified. When also you go ahead by clicking the notification bell there. Then another thing, I also want you to please, I will only know that I'm touching live, or I will only know that I'm actually we are on the same page, or you're understanding whatever I'm trying to do, or whatever I'm trying, the information I'm giving you, when you drop a comment. So when you drop a comment there, I'll be able to know that actually we are on the same page, or there are some areas that I need to touch on that I've not touched on. So please, that's all I had for you today. Thank you, and see you in the next episode.